Thank you, Anup. And it's always great to come to this forum, to this organization, Money Honey, because it's very unique in the way in it is structured. I have a lot of respect for what Anup does, and hence I am always happy to share what we have. We only have knowledge, nothing else. Uh, so what I intend to do is for the next 20-25 minutes, take you through a prepared presentation, but also would want responses from the audience to some of the queries so that we can make it more interactive. Of course, there will be a Q&A session, but maybe just to make it more fun, we can make this entire thing interactive. So my topic is growth investing for wealth creation. We'll discuss that topic also, but first a very simple story. I'm sure all of you would have read and heard versions of this story, right? Yes. Uh, so the version is very simple. There is a goose that an old farmer and his spouse found. They brought it home, and every day, to their surprise, they saw that this goose gave them a nice golden egg. By selling this golden egg, they became very rich. But as with all humans, needs are limited, but wants are unlimited, right? So as they grew rich, they wanted to be richer. They wanted to be in the top 10 rich list, maybe. So this greed led them to thinking that why not kill this bird and take all the gold once and for all and sell it and become big. Maybe we'll invest that money and grow bigger in the equity markets. So they decided to kill the bird, and when they did that, they found nothing. The bird was gone, and the golden egg which they got daily was also gone. When you talk to your clients, sometimes do you hear shades of this story? Which means, let's say the client is doing well with his portfolio. Every year they're able to make 10-15%, but suddenly they decide 10-15 is not good. Let's make 50%, 100%. Is it? You are interacting with such clients, right? They want to make higher returns. And how do they want to do it? Switch funds. Take more risk, right? And sometimes they want to take risk with their capital. Remember, capital is that golden geese. Whatever money you have, on that you are able to get the golden egg, right? Every year you get something. One day you want to risk this entire capital so that you double it, triple it, or do something with it. Maybe you lose it. And that's what the story of the golden geese is all about. It's not about growth, it's not about value, it's about simple facts on investing. It's about how greed can create problems. So just remember, talk about this story. Maybe when you talk to your clients and they give you pushback on some of the things which you talk about. I'm sure you talk a lot of sense to your clients. You talk a lot of good things, right things to your clients, and sometimes you get this pushback. So this is one story we should always keep at the back of your mind, at the back of the client should keep it at the back of their minds so that they are not able to make any such mistakes. Charlie Munger calls it mental models. So this is one of the mental model you should always keep at the back of your heads. Now we come to our topic, which is growth versus value. So before we talk about compounding, trading, etc., let's take a quick poll. Do you think growth investing and value investing are different? Yes. How many of you think they are very different, and how many think they are same? Let's say, how many think they are very different? You can raise your hands. So less people. So how many think that they are same? No one. So at least I imagine that there are some people who think that they are different. So yes, there are certain crucial differences between what growth investing is all about, what value investing is all about. And I'm sure when you look at some of the funds which you are giving to your clients, you will see differences in these funds also. Some of them are value focused and some of them are growth focused. So what I will do is I'll try to give you some flavor on what is the difference between both of these and where do all of these come together, right? So let's first see the differences. Uh, Growth investing means buying companies which are good quality companies at a reasonable price and staying with it for a long period of time. And that is why we are talking about buy and hold. The guy is relaxing, doesn't do anything. On the other hand, value investing, the core value investing principle means buying cheap companies, right? And then selling them when the prices appreciate. That is why value does well, right? You buy cheap, you sell high. But once you have sold high, once again search for a new cheap company and then buy that cheap company, once again wait for markets to re-rate it, right? So that is the process of value investing. It requires constant monitoring, constant churn. So it is buy low, monitor, sell high, and then once again buy low. So we think while both of them are good, one is suitable for one type of a person, the other one is suitable for another person. So remember, both of these strategies are similar in terms of what they are expected to do, which is deliver superior returns, but each of them has a different type of a person for whom it is suitable for. So actually this should have been the first slide. What is growth investing? It is ability to buy good quality businesses. What is a good business? A good business is one which is able to generate high returns on capital. So suppose you are an entrepreneur and you start a business, and let's say you start a business with 100 rupees. If you start with 100 rupees and if the business is able to generate every year profits in excess of 20 rupees, then what happens? This becomes a good quality business. Suppose you start a renting business, a business of renting furniture. You buy the furniture for 100 rupees, right? And you start renting it. At the end of the year, after including all the breakages, the damages, and the cost of doing the business, you find out that for every 100 rupees which you have spent in buying the furniture, actually your profit is just 5 rupees. Then that is not a good quality business. That is a poor business. So you may like it or not, businesses are of different types. Some of them are good, some of them are not good. While we are talking about growth investing, we are only talking about investing in good quality business. The second feature is these businesses should be able to grow fast. So once again, if you start any business, if it is not going to grow, let's say you start with 100 rupees, every year you only get 20 rupees, it doesn't grow, it is not a great business. Why? Because ultimately the objective of starting a business is not to keep it stagnant. The objective is to keep growing it at a particular level so that it can compound capital. So the beauty of growth businesses is that they are able to grow fast. Think of which are those businesses which are not going to grow fast. I'll give you some example. If you remember, all of us used to read newspapers. Right? Newspapers were very popular 20 years back, 30 years back, 40 years back. But now, incrementally, in the last 15, 20 years, gradually you would have noticed a shift. People have started getting all their news from either television or internet or your favorite apps, right? So, newspaper as a source of news has become less and less relevant. And hence, that business has started to see a significant decline. So, that is an example of poor quality business which is not able to grow fast. Similar examples could be cable television. In the 1990s, I don't know, you might be kids, you might be having cable TV at home, right? If you take a poll today, how many people would have cable at home? Very limited, because most people would have switched to apps, once again, OTT apps, internet on television. So once again, there is a shift in the business. So these are examples of businesses which are declining. Similarly, there are examples of businesses which grow at a slower pace. Growth investing focuses on buying businesses which are able to grow fast. So these are two very, very crucial qualities of growth businesses. And final and the most important uh, sort of deciding factor for whether or not we will buy or not is the price. So once we have decided whether if the business is good, if it is going to grow fast, then we decide whether we should buy it or not depending on the price at which it is available. A attractively priced growth business is good. Or if a business is available at a high price, it is bad. We will discuss what is high and what is low, but the definition of growth investing is largely buying good quality, high growth companies at a fair price. And if you can see the two bubbles, this is the classic definition of growth investing and value investing. Growth investing means buying good businesses at fair prices. And value investing means buying fair businesses at good prices. Remember, both of these are paths to achieve good investment returns. So I don't know how many of you would have read Bhagavad Gita, but in that Lord Krishna talks about three methods of achieving nirvana: Bhakti Yoga, Jnana Yoga, and Karma Yoga. How many would have at least heard about this? So many, see, very nice. So there are different methods of achieving nirvana. But is one method superior over other? People thought it is that Lord Krishna talks too much about Karma Yoga. So he thinks that Karma Yoga is the superior path. It is not. He says that all of these are three different paths to reach the same place. If it's like let's say there is a building at the center and there are three different paths which lead to the same building. Now, different people can walk on different paths. For some people, Jnana Yoga is simple. For some people, Karma Yoga is simple. So, whatever you feel you are able to do, or you can practice that and achieve the ultimate objective, which is nirvana. Same is the case with growth and value. If you are comfortable as an investor buying growth companies, then stick to growth investing. If you are as an investor comfortable buying cheap companies, then stay as a value investor. You know who doesn't make money? Because if growth investor makes money, value investor makes money, then they have to make money from someone. Who loses money? Anyone can answer that? Trader. So trading is a simple word, but I would just say flip it like this. Anyone who hops from growth to value and value to growth. आज growth चल रहा है, we'll buy growth. आज ये fund चल रहा है, we'll buy this fund. You would have experienced that, right? So clients or investors who chase returns are ones who actually lose. And people or clients who stay disciplined, or investors who stay disciplined, stay the course, are the ones who make money. So it is not about growth investing or value investing. It is about staying disciplined to make money. Decide which segment or which part of investing is comfortable to you and stay with that for a long enough time period. Otherwise, you will be butchered. So this is the evidence. Why do we say and why do we feel that growth investing is good? Why do I feel more comfortable with growth investing is because based on historical data in India, it tells me that historically growth investing has done very well in India. If you would have invested in a basket of growth companies, diversified basket of companies which are growth without doing any selection, you would have delivered or you would have made much better returns compared to any other segment of the market. So this is the evidence which we talk about. In the last 20 years, 7 out of 10 years or 14 out of 20 years, companies in the growth investing basket, which is companies which possess both high quality and high growth, have delivered superior returns compared to any other segment of the market. And hence, from an investor perspective, you cannot time the market. You don't know when the market will go up, down, etc. Then what do you do as an investor? You simply remain invested in growth companies. And why it has won? For the simple reason, you would all have heard, stock prices are slaves of earnings, right? So if earnings grow fast, stock prices also follow. So once again, when we look at this data for the last 10 years, so what I've done is looked at the all NSE 500 companies, right? Those are the companies which are available to me today. Taken all companies which have 10 years of history, right? So for example, some of the companies in NSE 500 would have come via an IPO in 2020, 2018 or 2022. We have not considered them. So what we have done is we have considered only 10 companies which have 10 years of history. There are some 350 odd companies, 350 or 360 companies. And then we have taken all of these 360 companies ka starting net profit and ending net profit, which is 2015 or 2025 ka net profit. Simple to do, right? All historical data. And then you get how much is the growth rates for each of these companies. And you did a sort. Companies which have the highest growth rate at the top, lowest growth rate at the bottom. And then we looked at what has been the stock price returns for the same companies. And this is the average numbers. Companies which are high growth in terms of profits, you can see if on an average, companies which have been able to grow at 20% have delivered 21% returns. And remember, it is March 31st to March 31st. We've not taken any averages, done any other things. Simple, take all 360 companies and unka average dekh lo. Average of the top 25%. So 360 ka 1/4 hoga 80. So top 80 companies on an average delivered 20% net profit growth. On an average, they grew 21% stock price. Similarly, on the other end, bottom pay last 80% companies, 80 companies, on an average grew their profits at 7%. And they delivered a 12% stock price return. Very simple analysis which tells you, of course, we all knew stock prices are slaves of earnings, but this gives you further evidence. So if stock prices are slaves of earnings, then if you are able to create a portfolio of companies which are growing at a fast pace, and not change it. The problem is we fund managers keep too much of trading. So fund managers should also not trade. Identify companies which are able to grow fast and stick with them for the next 5 years, 7 years, 10-year period, and your overall returns for the portfolio should also be good. So this is what the study suggests, and that is why growth investing has won in the past. The next question which I have been getting most frequently is, so you mean to say that when growth companies and many of these companies which are good companies which are growing fast, they tend to get a very, very high valuation. Some of them are trading at 50 PE multiple, some 70 PE multiple. Don't you think these are expensive? Of course, many of them are. But let's flip the question. There are some companies which are trading at 5 PE multiple or 10 PE multiple. Do you think they are cheap? So what defines cheap or expensive? For that, you have to delve a little bit more into financial theory. I will not bore you with financial theory, but I'll give you one very simple formula which you should know is at the heart of valuation. You can later do a Google to understand that. Very simple formula, and it is called value of a growing annuity to perpetuity. What is the value of a growing annuity to perpetuity? This formula is the heart of all equity valuation. When we have time, we can discuss, debate, talk about more about this, but this is more for the finance class, not here. The derivation from this formula is that if a company is growing fast, all other things remaining constant, there are two companies, one is growing fast and one is growing at a slower pace. Company which is growing fast will command a higher or should command a higher value compared to company which is growing at a slow pace. And this is not based on any market valuation, etc. This is based on hardcore financial theory. So point number one, high growth companies should get higher fair PE multiples. Second, companies, let's say once again there are two companies, one which has a high return on capital and another one which has got low return on capital. The one which has got a higher return on capital should trade at a higher PE multiple than the one which has got lower number, correct? Once again, based on pure financial theory. So there is a concept of fair PE multiple. Every company, just like we all have fingerprints which are different from each other, no two person is same, right? In this entire hall, if I take fingerprints of everyone, it will be different. Same goes for companies. Everyone is different and unique. Everyone has a unique fingerprint or fair PE multiple for them. And this fair PE multiple is based on 4 factors. And each of these 4 factors, I mean 3 of these 4 factors are different for different companies. So what are these 4 factors? First is, what is the forward earnings growth? Forward meaning next 5 year, 10 year, 100 years. This is what you have to judge. What is going to be the forward return on equity? Third, what is the riskiness of this business? Higher risk business means lower PE multiple, and lower risk business means higher PE multiple. And fourth, what are the level of interest rates in the economy? So this is a factor which is constant for all companies which will be in India. It will be constant for all companies which are in America, country specific. But the 3 factors are very different for each company, irrespective of which country it is. All of these 4 factors decide and help us understand what should be the fair PE multiple. Suppose the fair PE multiple of a company is 30. If it is trading at 20 PE multiple, it is cheap. And if it is trading at 35 PE multiple, it is expensive. Similarly, even for a low quality company, if it is trading at, let's say its fair PE multiple is 10, and if it is trading at 7 PE multiple, it is cheap. If it is trading at 12 PE multiple, it is expensive. So 12 is not cheap and 30 is not expensive. It is your multiple relative to what you should be trading at. So that is what reasonable price is. And we have clearly seen this in practice. So all of this is not just theory. We have some 215 companies which are in our universe for which we calculate this fair PE multiple. And you will be surprised to see that markets are very smart. When we get a fair PE multiple for some company at 35, they are either trading at some 40 PE multiple or 30 PE multiple. They are not trading at 10 PE multiple. Similarly, for a company where we get fair PE of 15, they would be trading at 18 times or 20 times, or they would be trading at 15 times or 12 times. They are not trading at 30 times or 5 times. So market is smart. Don't think that by buying a low PE company you will be doing value investing and vice versa. So I think that is what reasonable price is all about. And then when we select stocks, very high level basis pay, these are the things which you want to look at. High quality business means companies where returns on equity is high. Typically 15% return on equity is considered to be good. We want this return on equity to be sustainable. What is sustainability? As I said, newspaper companies used to make 200% return on capital. And now they make 10%, 20%. So their ROEs are not sustainable. They have, or the moat around their castles has got eroded. Enemy has already attacked the castle and destroyed it. So we want businesses as investors which have a sustainable return on equity. And on the other side, we want high sales growth. What is it dependent on? Scalability of a business. What is scalability? So I'll give you one example. Suppose you are a chartered accountant. Let's say there is a best chartered accountant in Bombay. He sets up a practice. And because he is the best chartered accountant, he gets a lot of clients. Let's say he gets 100 clients and he is making very strong profitability. Can he set up another branch in another city and expect the same number of clients to come to him in the other city? Remember, he is not going to consult them. Do you think it will happen? No, right? That is what we call as non-scalable business. If you are an investor, you need businesses which are scalable. So I'll give you an example of scalable business. You have, let's say, a retail shop very close to you. This retail shop keeps lots of grocery and stuff like that. And this does not have any high profile person because of which you go to the shop. You go to the shop because the shop is good, right? So now the owner of this retail shop can set up more shops all around the country and they will expect more people to come in because they're coming because the shop is offering cheap products. This is an example of scalable business. If you set up a cement plant which is cheap and you have got a recipe for making that cement plant cheap, you can set it up in one place and repeat it by setting it up in other places, and that's a scalable business. So the business should be scalable. Second, disruption proof. Well, there is no guarantee any business will be disruption proof, but as far as possible, invest in companies which do not get susceptible to disruption. If you remember, Warren Buffett talks about technology, that I don't invest in tech companies because I don't understand them. It is not that he cannot understand what is tech. When he says I cannot understand them, it means he doesn't understand what will change to disrupt these businesses. So what happens if tomorrow no one comes to these businesses? Right? There are so many examples of tech companies which we no longer use. I won't go into details, but I'm sure you can relate to a lot of software or business or websites you are no longer using, but you were using 10 years back or 20 years back. Third is the business should be innovative. They should keep launching new products, new ideas, so that old things get replicated, new things take time to get replicated. So if you keep doing new and new things, for shareholders, you create a lot of value. And finally, the business should be less cyclical and diversified. So these are different types of moats. I won't go deeper into them. Each is one big chapter in itself. We can spend one hour on each of these moats. We'll not do that. But if you just look around, you will be able to correlate with a lot of them. So I'll just give you one example of network effect. All of you have WhatsApp on your phones, right? Today, if I want to start a WhatsApp-like service, do you think you will use my app? You will not. You know why? Because you are using WhatsApp because your friends and relatives are also on WhatsApp, right? You are not using a new app. Let's say there was a time when people used to talk about Signal or Aratai or some other such app. But no one used it. You know why? Because not everyone is on that app. You are on that app because others are also on the app. Right? And others are on the app because you are on the app. So this is an example of network effect. Stock exchanges are examples of network effect. So this is one very important, very difficult to replicate moat. And businesses which exhibit this are very attractive. Sorry. Then there are others like economies of scale. It's very self-explanatory. Government regulation, switching cost. Brand. By the way, switching cost is the razor blade example, or example of the printer cartridge. How many of you would have bought inkjet printers at home? Maybe 5 years back, 10 years back. The printers were cheap, deliberately cheap. So the printers used to cost 2,000 rupees, but the cartridge for using in that printer used to cost 750 or 1,000 rupees. And this cartridge needs to be refilled every 6 months, 1 year. And that's how the companies made money. That's called switching costs. You can't switch printers because you have invested, you have bought a printer at home, and now you need to keep buying the cartridges. So that's an example of switching cost. Brands, trademarks, we all use toothpaste by a particular brand. That is what brand equity is all about. You don't look at any other brand. Same goes for many other things. Patents and copyrights, drugs are in pharmaceuticals belong to this. There are distribution related modes and data and insights related mode. We will not go much deeper into them, but each of these is a individually important sort of moat or competitive advantage which companies exhibit. As investors, we need to identify them and stay in companies which have some of these characteristics so that their returns on equities remain strong. This is a little heavy sort of a slide. Don't focus on the numbers because you just need to focus on the highlights. So what I intend to talk about using this slide is that when you buy and sell, even with the same rate of return, let's say you get 15% return on your investment every year. But every year you keep buying and selling to generate this return. And on the other hand, there is an asset which keeps generating 15% return on the starting investment without buying and selling. The ultimate result of this is that someone who keeps buying and selling, because of payout of taxes, every year you need to pay capital gain tax. So I've presumed that there is 25% gains on tax for example's sake. If that is the case, just because a buy and hold strategy postpones payout of tax, you make 13% more benefit in this example. If you read a lot of Warren Buffett notes or his comments, he always talks about buy and hold as a strategy to defer taxes. So this example shows you how deferring taxes also creates a lot of superior benefits to investors, even at the same return on investment. Now, one more concept where I need your help. You would have heard about this diversification concept from a lot of people like us. You get so many people who talk about markets and diversification. Some people tell you, you should have 5 funds. 5 funds is good diversification. Someone will tell you, no, you should have 20 funds. 20 is good diversification. If you ask a fund manager how many stocks you have in his portfolio, he says 50 stocks is good diversification. Someone will tell you, no, 100 is good diversification. So you will get confused. Ki diversification hota kya hai? What is it and why is it important? So for that, let's play a simple game. Okay? And let's assume right now, we don't have it, but let's assume we have the coin which is used by Amitabh Bachchan in film Sholay. Everyone has seen Sholay? Seen, no? So because no one is responding. So you know the coin which Amitabh Bachchan used to use. So that coin had a speciality. And let's say we have the accurate numbers. 70% of the time this coin will always produce head. 30% time it can produce tail. But biased coin hai. So it will produce head 70% of the time. So we'll call it Sholay coin. So we are going to play this game with the Sholay coin. Okay? In this game, let's say if you predict heads, you get 120 rupees. If you win, the coin shows head, you get 120. But if it gives tail, let's say after the flip you get tail, you have to pay 100 rupees. Right? Everyone understood this game? Now, a question. How many of you will bet your entire net worth on one flip? Please raise your hand. नहीं ऐसा नहीं हो कि everyone doesn't raise hand for anything. So one flip, no one? No one. Despite the fact आपको पता है कि 70% of this is Sholay coin, and 70% of the time you will be right. But you don't want to take that risk, right? Chalo, let's flip the question. If I tell you, I will flip the coin 100 times, and for each time you just bet 1 divided by 100 of your wealth. How many of you will take it? Some of them understood. See, there are some people who are now taking it. Let's ask the audience, why will you not take the second bet? What is the risk? You are betting 1 by 100 and you have a 70% chance of winning. Chalo, ek kaam karna. Take this example, put it on a spreadsheet and use random numbers for the outcome, the heads or tails. But with the caveat that 70% of the time, head aana chahiye. You will notice 100% of the time, there will be no single time where you would have lost on an aggregate if you take the second bet, which is 100 bet, 1 divided by 100. मतलब कुछ भी हो जाए, you will win. this is too sweet an offer, you should never deny it. But the first one is a high risk offer. Why? Because you have, even with 30% probability, you have the chance of losing your entire net worth. And this is what diversification is all about. It is not just a number, it is that sweet spot where you are able to sleep well. So it is once again unique to each person. There are certain rules of thumb, but as you can see, using this example also, the level of benefit which you get out of diversification starts to fall after 20 or even 15 names, 15 tosses. So as the complexity of a problem goes up, you need a higher number of coin flips. So for us, for example, when we invest in stocks, the answers are not so straightforward, and hence, since it is little bit more complex, the level of diversification, which is the number of companies in which you need to split the portfolio, can go up beyond 30, 40, 50, something like that. So remember, there is no right or wrong answer, but keep this coin flip example in your head when you are thinking about diversification. It just tells you that it is a sweet spot which helps you sleep well when you are taking risk. Because risk means the outcomes can be either good or bad. Once again, this just gives you the same sort of strategy detail. It is a study which we did on the markets, and once again, I won't repeat the entire thing, but what this study did is we looked at last 20 years of data for all companies, and we took the top 500 companies in each year and segmented them into high quality, high growth, or low quality, low growth, or somewhere in between. The results were that on an average, companies which are high quality, high growth, which is at the top table, we can see companies which are high quality and high growth delivered a 3% annual alpha compared to almost negligible numbers for any other strategy. And hence, these are my final thoughts. You will be heaving a sigh of relief. These are some of the big picture takeaways which I want you to leave away with. First is, growth investors buy quality, fast growing businesses at fair prices. Growth is not buy at any price. Growth companies means companies which are good quality and high growth, which are bought at reasonable prices. High growth and high quality companies show superior long-term returns and consistency. So once again, what we have looked at using historical data, that companies which are good quality stay good quality for a long period of time. ऐसा नहीं है कि one year it is good quality, next year it is bad. Companies which are in the high quality segment remain high quality for a long period of time. And vice versa. Companies which are low quality also remain in that segment for a long period of time. So generally this is what has been observed. Strong moats and high profitability help companies sustain outperformance. So once again, this is what has been observed in market studies. Compounding beats trading through tax efficiency. And as we just discussed, there was a tax advantage of deferring taxes in buy and hold strategies. And finally, a data-driven and repeatable process reinforces growth investing's reliability. So why do we need process? By the way, a lot of people come to you, every fund manager comes and tells you we have a process. No one says that we don't have a process, right? So why do we, first and foremost, why do we need a process? Because process ensures that whatever historical outcomes have been achieved, they are repeatable. So if you are following a random system, then whatever you have achieved in the past may not repeat. Like for example, if you play a game of 7 up, 7 down, you have played it in various fairs, right? If you predict XYZ, let's say 7 up, 7 down, and let's say for 5 times you have won. Based on this track record, will you, 6th time, will you bet your entire net worth? No, right? You know why? Because there is no process. Historical data, which is that you won for the 5 times, has got no relation with each other. So 6th time jo aayega, which will be completely different from the 5 times. But let's assume, for hypothetical purpose, let's assume you noticed some flaw in the game. Ki bhai, let's say whenever he does XYZ thing, 7 up aayega ya 7 down aayega, hypothetically, right? You notice something, और वो चीज को आपने notice किया and you took advantage of that, and because of that you won 5 times. Don't you think you will increase your bet size when it is the 6th time? Isn't 6th time ka return predictable or more predictable than? This is what process is all about. Process should make historical returns much more palatable. They should be repeatable. Otherwise, process is of no use. Yeah? Those are my final thoughts. Thank you very much. We can take the question.